my title here is sort of deliberately provocative, given that the focus at the moment on UK stocks and shares is the fact that we have about nearly 20% of the index in mining and oil stocks, which is, perceived as a safe haven because of the inflation threat. And obviously the crisis in Ukraine. But first off, if I may, as a UK fund manager with the precious 15 minutes to talk to you, what on earth am I doing on the first page daring to talk about the giant tech companies that have dominated global stock markets? It's really just to sort of remind you of this juggernaut that has dominated markets, and because UK equities really have been kind of on the other side of that trade. We've been the whipping boys for over 5 years now. So yes, trends go on for long times in markets, but they do finish. And I just think for context, it is just interesting to remind yourself there, top left, the extent to which the US market has outperformed globally everything else. And in particular on the top right, you can see that in particular the big drivers are the big 6 tech names that have dwarfed whatever else is going on in the US index. And the bottom left is showing, yes, indeed, these 6 companies have been very successful at driving their earnings growth faster than the rest of the US market, which actually, if you stripped it out, the rest of the 494 names, the aggregated earnings growth doesn't seem any different to what's been going on elsewhere, actually. But the most important chart of these 4 is the bottom right, really, which is showing that despite that attractive progress in their cash flows and their earnings, the major driver over the last 5 years of their performance in terms of capital growth is because of the re-rating. So what I mean by that is the price that investors are prepared to pay for those given cash flows and earnings over the last 5 years. And, so it's been the perfect storm with all the disruption, but also crucially with incredibly low interest rates since the financial crisis 12 years ago. That's accommodated a kind of re-rating of those sorts of businesses. And the narrative through the COVID crisis is that these are defensive safe havens, whatever the economic prognosis, the geopolitical prognosis, these companies can sail through. Now, operationally, some of them may well, but what we've seen hints of over the start of this year is that good businesses can derate as well, and that's what you saw in the 70s. If there's a bit of a narrative that are we going back to 1970s stagflation, well, back then there was the equivalent of these big US tech names. They were known as the Nifty 50 back then, safe haven in the first oil price crisis. And yet those sorts of stocks, which included the Pepsis, but also included Rank Xerox and Kodak, and they subsequently derated substantially and started to underperform even before the market lows in 74. So what is defensive? Valuation does matter. And I think that's a real important reminder of what started to happen this year. So in terms of the UK, on the left-hand side, there's no silver bullet as how you assess the value of a business, but as a kind of rough guide, it's interesting to look at a combination of the price to the earnings and the dividend yield and the price to book. You can just see on the left hand side there the extent to which, gosh, the UK has suffered a real beating, and that the magnitude of the underperformance of the asset class has meant you've really opened up this valuation gap, going back to the kind of extreme discount that you saw again back in the mid 70s. Now, I know there's a narrative to backfill, to rationalize why that is. We've got no big tech names in the UK index. We're overpaying dividends at the expense of investing in back in the business. All kind of interesting narratives, but it's not the main reason. And I do think it's more the magnitude of what's going on the other side of the equation, and this phenomena of these big tech names in the US. And going back to what Ryan was talking about, it's you've got to remember that over 50% of the AUM in the US is now passive. So it feeds on itself, the capital being sucked into a relatively narrow part of the global market, and that's opened up this big valuation opportunity in the UK markets. Now, what I would say is that I'm never happy. So, so yes, finally, the UK market seems to have done relatively a bit better at the start of this year, but it's very much been dominated by the inflation hedge and the fact that it's an index that's in the UK that has a lot of oil and mining exposure, and obviously banks, if you believe interest rates are going to continue to rise, will help net interest income. But what I'm trying to show on the chart on the right here is that even if you strip out oil and banks, that valuation extreme, it is a sort of a two standard deviation. So we think the opportunities in the UK market is not just as an inflation hedge, and that away from commodities, there's a lot of good businesses that happen to be quoted in the UK. Whereas if they were quoted on other indices, they would command higher rating, we would suggest. And it's just this quantum of money that's come out of the index as a sort of anti-momentum trade over the last 5 years. And that, for active investors like ourselves, creates great opportunities. We're owners of businesses. We're not trying to be overly reliant on what's around the corner macro wise. That's not where we've got an edge. It's doing the work at the stock level. What levers can a business pull? What is the intrinsic value of a business? And the next page 4, is really saying, so if I'm Boy Who Cried Wolf, and it's all very interesting, yet another UK equity fund manager saying I'm cheap and unloved. Everybody's been saying that for on and off for the last 3 or 4 years. If you want to continue to allocate more and more of your savings into global, into US tech, and you want to sell UK equities, who's buying those shares? And what's interesting is that the marginal buyer of UK quoted stocks are private equity, overseas corporates, and increasingly we're now getting activist investors on high up on the share register of a lot of UK names, including the very biggest names. And these guys, they don't have a view on Boris or our economic outlook. They're looking at the cushion of valuation that has opened up because of this weight of money that's come out of our index. And so, we're fighting hard, because where we last saw a very elevated level of acquisitions globally and particularly in the UK was back in the mid 2000s, 2005, 6, when companies like P&O and O2 and Allied Domecq all got taken over. Now, when that happened, it was kind of the icing on the cake, if you like, in that we'd come out of the 2000 recession and the technology, the dot-com bubble burst, and we'd seen a recovery in earnings. UK market actually outperformed. I'll repeat that: the UK market outperformed the US from 2000 2006, and sterling, likewise. So we did well in that period, and then on just as we're coming to the end of that 5-year, 6-year period, we got incoming bids. So we'd already had a recovery in earnings and re-rating. So that was icing on the cake. This time, shares, are trading too cheaply. So, we're really wrestling, and that's why we were the second biggest shareholder of Morrison's when that was taken over last year. Shares had gone sideways for 5 years. Operationally, made big progress under a new management team that we were involved in bringing in. And we could see the value of the assets and the cash flow, and the stock market just wasn't interested. And fortunately, there were two bidders came in, so that allowed us to get up to a 60% premium, cash premium. But if there was only one bidder, we might not have got near to the true value of that business, and that's what we're fighting for as an owner of a business. Likewise, in 20, RSA, the insurer, again, we were second biggest shareholder with about 10% of the equity on behalf of our clients. Again, that was a 50% cash premium with two corporates bidding for that asset. So, they're seeing the value, even if wealth managers aren't. And it is quite depressing that of all the Western savings markets, the UK savings market has the least exposure to its home market. It's just been allocating more and more away from UK equities, and that's created this value arbitrage, which activists, private equity have spotted and are exploiting. So it's no good wrapping yourself in the flag after the event and saying, gosh, that asset went out too cheaply. It went out too cheaply because not enough of us collectively are recognizing the value and staying invested in UK stocks and shares. Sorry, that was a bit of a rant, wasn't it? But so the summary, before I talk a little bit about the funds, is we've got a lot of value on the table in the UK markets. Yes, we've got uncertainties with the geopolitical situation, but as you should well know, that the best time to invest is to lean in when things are uncomfortable, not when we're all euphoric after we've discovered vaccines, etc. You don't wait for the event, you lean into it, really. And so that valuation cushion relative to history and against the global index, gives active managers like ourselves, real good opportunities to add value, hopefully, for you. And who are we fighting against? Who are we competing against? Well, the market day by day is dominated by quant funds, hedge funds, basket trading. There's very little individual stock trading that goes on. The money that's driven through the bulge bracket investment banks is all in these exchange tradable funds, these basket trades based on thematics, and you could get horribly whiplashed if you think there's real information in that. It's sort of all in the hokey cokey inflation trade. Oh no, deflation. It's sort of whipsaw, and it's sort of, you've got to stick to what you want to do and what your medium and long-term goal is, and where you as an investor think you've got an edge. So that's really important, and everybody bands around ESG, etc., but that's our bread and butter. It's good governance. We're owners of businesses. We're trying to be flag bearer for the K code, really. So that's, and as I say, the M&A is not going away despite the Putin issue. We've had incoming, obviously, approaches from private equity, Apollo for Pearson, the media company, again, which we're a major shareholder of, Stagecoach, cash bid from an infrastructure bidder. So there's stuff going on behind the scenes. There's a lot of counterparties with big firepower, and they're focused on the UK stock market. We're trying to be a focused fund, hunting for good ideas, primarily lower end of the FTSE 100, top end of the mid 250. We've got major positions in stocks like AstraZeneca that we've owned for more than a decade. So we try and buy stocks when they're out of favour. The market sees shadows everywhere, and usually double counts, puts distressed cash flows and earnings on a distressed valuation, and we try to work with it, be patient, and get the double whammy on the way out of a re-rating on improved, stronger business. And we want to run with that. So there's some fantastic businesses, world-class businesses in the UK stock market, even if they're not big tech names. And we want to capture those early when they're struggling with some issues, but then hold them for the long term and keep challenging them, obviously. But it's this idea that you're either growth or your value. We think the world is more nuanced, and Ryan gave a Warren Buffett quote. Another one of his from the mid 90s is many investors see any mixing of the two terms as a form of intellectual cross-dressing, which he thought was fuzzy thinking. That they should be joined at the hip. Growth is always a component in calculation of value, and seeking value is not just in looking at price to book or a couple of simple ratios. It's getting under the bonnet, really. That's what we want to do. So I know you've seen different cut on the performance of the fund, but that's a different way of looking at it in terms of rolling years. So as I say, we're not trying to glide over the waves and perform every quarter or every year. If you're an active fund away from the index, you're trying to do something different, but you need to have enough Morrisons to make a difference when the bid comes, or enough AstraZeneca long before they've started to commercialize that pipeline of new products. And that's the sort of a crude going back to the late 90s.